Hello everyone, this is our last theoretical module for today. We started with some high-level presentations and lectures from MIT regarding property, plant and equipment, acquisition, initial recognition, subsequent measurement, depreciation, and disposal, gains on loss and on disposal, a reflection in the cash flow statement, income statement, and so on. Useful life, salvage value. We did a bit of coverage. All of these concepts, they are covered in the PwC guide. And in above, you can find the links to folder for this lecture, and you can find the link to the guidance, and you can find the link to a spreadsheet where I summarized some pieces of a guidance. Let me add some size here. Let me see if it's even visible on mobile device. Let's higher picture quality. I'm monitoring just to make sure that whether it's readable or not. Okay, this way on my iPhone it seems more or less readable. Not the best, unfortunately, but it's not a quality issue. It's probably a size issue. Let's see. Let's see. I if I want like 150. What if 150? This way it might be a bit better. Okay. Let me turn it off. Okay, let me know if you have any issues to quality or sound. Everything should be running fine right now. So let's start. We start with PwC Property, Plant and Equipment Guide. In the beginning, you will find that it says that it references to US GAAP, and it also lists other sources of accounting guidance, and it also has a lot of changes and updates. So accounting guidance evolves over time, and in this guide, it's pretty well documented. It's pretty clear. Let me refresh my page here. Okay. And why do we need to capitalize costs of property, plant and equipment? And the main answer is because we use those assets over many years, and we need to allocate expenses from that assets to the revenues which we generate with the help of those assets. And if we expense those assets straight away in the first year, our costs will not match our revenues. So that will be a contradiction to the cost matching concepts. So the answer is to match, cost should match revenue. That's why we depreciate the depreciable basis of our fixed assets over their useful life. And typical property, plant and equipment includes land and land improvement, buildings, machinery and equipment, furniture and fixtures. And all of that is mostly segregated this way because it has a bit of different substance, but it also usually has a different useful life. So your buildings, so land has kind of indefinite useful life. You do not depreciate land. Land improvements actually might have a useful life. And buildings and structures usually have pretty long useful life, like 15 years to like 40 years. Machinery and equipment, it's like trucks, some equipment. It may have a 3-year useful life, 5-year useful life, 10-year, or maybe even 15-year. Furniture and fixtures, usually like 3-5 years. And you based all the life estimate based on your professional judgment. In the acquisition of property, plant, and equipment, especially when we talk about buildings or some complex plant, there might be a situation when we acquire the assets in its as it is ready for production. We just pay cash and get an assets which is ready for production, or we might want to develop the assets ourselves to be involved in the construction in the assets. And depending on that situation, our capitalization process might be different. We should, in theory, we should end up with a pretty much similar amounts for the assets constructed by ourselves or the assets purchased. There might be some adjustments related to the condition of that assets. There might be some seller profit involved. There might be some capitalized costs, but the standards say that the one of the aims of the standards is to make these amounts comparable. And we will touch that when we will talk about interest capitalization principle. Okay, so what do we have here? AC 360 deals with property, plant, and equipment. Let me tell you the exact name of that. AC, I think it's property, plant, and equipment, right? And as an interesting point for that ASC, it does not include any specific guidance for capitalization of costs incurred during the development of self-constructed, let me highlight it, self-constructed assets. So self-constructed assets are not covered by property, plant, and equipment accounting standard codification. But despite the lack of authoritative guidance, and I remind you that ASC 360 is basically this kind of single source of authoritative guidance. You might also have Securities and Exchange Commission guidance. There is quite a bit of different other guidance, and one of which is a statement of position from the FINREC, accounting for certain costs and activities related to property, plant, and equipment. And we will cover that. And it says, although it is not approved for issuance by FSAB and is non-authoritative, it contains guidance related to capitalization of cost of an assets constructed. And as you see, from this chapter, we have an accounting for capital projects, and which says that we usually report PP&E in its historical cost, which is the amount of cash or its equivalent paid to acquire an asset and is commonly adjusted subsequently for amortization, depreciation, and or impairment. And the historical costs. So we have what is we might ask ourselves, what is a historical cost? And historical cost is whatever we paid for the assets plus just give me a second, I will check that translation is running good. So the historical cost is the cost of acquiring an asset, cost necessarily incurred to bring it to the condition and location necessary for its intended use. So it is not only what you paid to the vendor, but it is what you paid to bring it to location where you are going to use it, and what you spent to put it in the condition in which you will kind of use it. What else interesting do we have here? I did some work yesterday and highlighted some stuff in this guidance. Just the most interesting moments. So when you deal with property, plant, and equipment for the first time, it will be good practice to go read and of the standards. Generally, what you need to remember is that your cost should include not only vendor price, but also transportation and whatever is needed for the intended use of the asset. But there is something that you can include into that cost, and there is something which you kind of cannot include into that cost. And let's find out it later. What we have kind of activities necessary to acquire PP&E and bring it to its condition and location necessary for its intended use. Activities. The term activities is to be construed broadly, and it encompasses physical construction of the assets. In addition, it includes all the steps required to prepare the assets for its intended use. For example, it includes administrative and technical activities during the pre-construction stage. So pre-construction stage, such as the development of plans or the process of obtaining permits from governmental authorities. It also includes activities undertaken after construction has begun in order to overcome unforeseen obstacles such as technical problems. So basically, a construction project is a big deal, and it has several stages. And depending on the stage, you may or may not capitalize some expenses, and it's all broken down further here. And also, if you got some unforeseen obstacles, such as technical problems, labor disputes, or litigation, you might also be able to capitalize those expenses on the cost of your asset. Okay. When determining which costs should be capitalized for assets that are self-constructed, we need to distinguish which are necessarily incurred and those that could have been avoided by the reporting entities. And a clear example for this is penalties and fines. So if you got some penalties, so you see you can have some unforeseen obstacles, and you might be able to capitalize those. But if you got penalties just because you are bad at managing things, then those penalties cannot be capitalized and must be expense. So you also need to think about what is necessary to be included in that assets. And I will remind you, we talk here about something a bit more complex than just purchasing a car or purchasing, I don't know, simple building which we are going to use straight away. We are talking about capital projects which involve several stages. But the principles are universal. Generally, costs incurred for replacements or betterments of property, plant, and equipment can be capitalized when they extend the life or increase the functionality of the asset in question. So that's basically, remember we asked the question in which case your expense related to the property can be capitalized. And the answer is when the costs incurred for replacements or betterments actually extend the life or increase the functionality of the assets in question. Okay, otherwise they should be expensed as incurs, like repairs and maintenance. Capital costs may include labor, materials, supplies, transportation, engineering services, certain overhead costs, insurance, employee benefit, taxes, and interest. So an expenditure that adds to the productive capacity or improves the efficiency of an existing asset can be considered a capital item. And costs incurred during construction that are directly attributable to placing it into service should be capitalized. I will get a quick step back here. I copied in one of the links I shared above. I copied a bit of important concepts. So content. So this audit guide content has like a lot of chapters, and we will be looking only on 3 for today, and maybe for that course. And I also added some extracts related to capitalization of costs, as well as some pitfalls. For depreciation, I didn't add much, but okay, let's come back. Let's come back to the standard. There is a guidance. There is actually a guidance in AC 970 about real estate, which talk about what you can and cannot capitalize. Incremental guidance on capitalizing the costs of real estate developed or sale of rental. That guidance explicitly excludes capital projects constructed for a reporting entity own use. So it's a bit of controversy here. So we have a real estate guidance, and as expected, it talks about real estate. However, in the absence of other authoritative guidance, reporting entities often apply the guidance in this accounting standard codification by analogy in developing their overall capitalization policies. So in a big company, the capitalization policy is a must. And since you do not have direct guidance in the standard, you use the real estate standard, accounting standard codification 970 real estate for some guidance. Okay, initial measurements of the capital projects. The cost of acquiring an asset includes the costs necessary to bring it to the condition and location necessary for its intended use. So again, that is just the main principle. Whatever you do, that's your main principle. I can highlight it several times with I can probably and in one additional guidance, SOP guidance, which we discussed above, they recognize 4 stages for the projects, and these are like preliminary stage, pre-acquisition stage, construction stage, in-service stage. Okay, so preliminaries, and depending on the stage, there are different considerations which you should give to the costs that you incurred in relation to the assets, as to whether capitalize that cost or not capitalize that cost. And preliminary stage is the stage during which the costs are incurred related to the long-lived assets when the project is not considered probable of being constructed. So you are only figuring out if you need that project at all. Let's see if I have. So you're only figuring out if you need that project at all. Okay, everything seems to be working. So imagine if you are planning a plant and you already need some consulting involved, consulting services, and you need to figure out if that project needs to be profitable at all. You build some Excel models, your employees spend time on that. You might want to go to local authorities and talk to them, and they might want to ask you to pay some fees to provide you some answers to the questions, and all of that can be official fees. And when you do all of that, what happens to those costs? Do you capitalize them to your project, or you expense them as incurred? And given the high degree of uncertainty about the future economic benefits, costs incurred during this stage are expensed as incurred. And preliminary stage, so you expense all the costs related to the project until you recognize that the acquisition or construction of the specific long-lived assets is probable. And probable, I believe, is like 75% probability. So in the other part of accounting standards codification, probability is sorry, got some cold, not COVID. I'm fine, thank you. In other parts of accounting standard codification, probable is quantified as 75%. So when we figure out that project is probable, we move to the next stage. And in that assessment of the probability, like 75% of what? How do we come up with 75%? We need to assess that we have a management that management with authority implicitly or explicitly authorized the project. So the company officially, based on its customer business practice, it authorized the project. Okay. Second, that the company has resources to complete whatever was authorized. And three, the ability exists to meet the necessary local and other governmental regulations. So you know that your project, that you will be able to comply with regulations. Because basically all of that is intended to say that you will be able to finish the project and you will be able to run the project and generate future economic benefits from that project. You can construct a building, and you can have resources available for that building. But if the building constructed against the law, against the permits of local government, then you won't be able, most likely you won't be able to use such buildings. So when you satisfy these conditions and you conclude that it's probable, you move to the next stage. And here we have a list of different stuff which you might incur in the first stage: exploration of opportunities, surveying, zoning, engineering studies, design layouts, traffic studies, and so on, different kind of studies. When we move into pre-acquisition stage, so that's when we concluded that it's probable that we will construct an asset. So when we do that, we need to differentiate between the costs which are directly identifiable with a specific PP&E and those which are an allocated overhead cost. And we capitalize directly identifiable costs and we do not capitalize overhead costs. All other costs related to properties that are incurred before the entity acquires the property or before the entity obtains an option to acquire it. So the third stage will be construction stage. And this stage is when we decide that the construction is probable, but we haven't kind of started construction yet. So we have a segregation that direct cost we can capitalize and indirect costs or overhead we cannot capitalize. And let's see for some examples what are direct costs and what are indirect costs. All other costs related to properties that are incurred before the entity acquires the property or before the entity obtains an option to acquire it shall be capitalized if all of the following conditions are met. The costs are directly identifiable with a specific property, so directly identifiable. The cost would be capitalized if the property were already acquired. So would be capitalized if the property were already acquired. Acquisition of the property on an option to acquire the property is probable. So that's basically criteria based on which we moved to that stage. So we can directly identify the costs. We would capitalize these costs on any stage of the project. And we remember the main principle of capitalization is that those costs are necessary incurred to bring it to the condition and location necessary for its intended use. So that's our main principle. Let me try to copy it here. I highlight it a lot. Okay. So that's the main principle. Acquisition of an asset and costs related to bringing it to the location where we plan to use it and put it in the condition which will allow us to use it. And yeah, construction is probable. So let's see what's included. Incremental direct costs of PP&E pre-acquisition activities incurred for the specific. Okay, it's pretty broad term. Certain costs directly related to pre-acquisition activities for the specific PP&E. These costs include payroll and benefit-related costs for employees who devote time to PP&E pre-acquisition stage activity. So basically, if you have employees working on some pre-acquisition of PP&E, working on some capital projects, so when you figure out that the construction is probable, you can start to capitalize their salaries and benefits to the cost of your project. And you will do that based on the allocation of their time to the extent of time the employee spend directly on that activity. So if someone working half of his time on some probable capital projects, you can capitalize half of his salary and benefit expenses, as well as some pensions. However, rent, depreciation, and other occupancy costs associated with the physical space occupied by employees should be charged to the expense as indirect. So if your employees work in your office and they spend time on capital projects while capital is not finished, while it's not in operation, you can capitalize the salaries of those employees, but you cannot capitalize like an overhead. So you remember we have a distinction here. Costs that are directly identifiable and costs that are unallocated overhead costs. So in that case, the salaries of people who work on the project are directly identifiable. And for example, rent, depreciation, and other like overheads are an overheads costs. Payments to obtain an option to acquire PP&E. The reporting entity should evaluate whether the option is derivative. So from time to time, we like, for example, like we do in mining industry, when we plan to do a mine, sometimes we need to buy parcels of land from different owners, probably from time to time from hundreds of owners. And if we start to buy those pieces of land, we may end up buying half of the land and some other owners will refuse to sell. And in that case, we will have a problem. We will spend money on a land, but we are not able to use it as intended. In that case, we use options. So we pay owners of land a smaller amount of money, like several percentages, so 5-10%, depending on the situation. We pay those costs to owners, and we buy an option for them to buy their land at the agreed price. So we do not pay them full price. We pay them only for an option, for the right to buy their land. And in that case, these options, they also can be capitalized. But it's quite a bit of other guidance which can be involved in here. So usually you just capitalize it, but you need to check the guidance first if depending on your context. So general and admin costs and overheads should be charged to expense as incurred. Okay, that costs include all costs, including payroll of support functions, which include executive management, corporate accounting, human resources, and so on. So only for employees who directly work on that CapEx project, only for those employees you can capitalize. Okay. If during the stage you determine that the project construction is no longer probable, you will need to assess that assets, whatever you capitalized by that date, you will need to assess it for impairment. You kind of need to write this off. If you cancel the projects, you write it off. So next stage, we move to construction stage. And construction stage begin at the time the reporting entity obtains ownership of PP&E or obtains the right to use PP&E through an agreement, like a lease. During this stage, costs are incurred to acquire, construct, or install the PP&E. This stage incurs costs incurred prior to the long-lived assets being available for its intended use. Examples of activities performed during this stage include planning for construction or installation once ownership has been acquired, construction or installing PP&E, and supervising the construction of PP&E. And the principle here is the same. You need to be able to directly identify the cost to capitalize the cost. So only directly identifiable costs are capitalized. And again, here is a list. So whatever you spent on PP&E and installation of PP&E is capitalized. Payroll and benefits, depreciation of machinery and equipment used directly in the construction of or installation of PP&E. Inventory used directly in the construction or installation of PP&E. Okay, you actually, no one is telling me that, but I can kind of zoom in a bit, and that will provide somewhat better experience. Okay, inventory. So if you use inventory, if you use depreciation, rent, depreciation, and other occupancy costs associated with physical space occupied by employees are not directly identifiable costs. So same principle as earlier. If you can directly associate the costs, then you can capitalize. Let's take a small practice break now. Let's go to our transaction list and let's do some double entry. So you cannot do accounting without double entries. Basically whatever you do, whatever you learn about accounting, it should have a reflection in the double entry. If it's not if it cannot be connected to double entry, it's not accounting, it's probably something else. It's just general finance or management or cost management, and so on. So whatever you learn, try to make double entries. Try to figure out double entries related to that. Let's do it this way. We determined that construction is probable. 3 criteria. What happens? And acquired an equipment which we should put on construction site and install and make ready for production. What else can we get here? Okay, let's leave it this way. We incurred first acquisition cost of equipment, let's say 1,000. Second, 25% of employees worked on that project. 25% of employees time was spent on that project. Total labor, let it be 100. Third, 50% of equipment time spent on that project. Total depreciation for that equipment 200. Okay, let's leave it that way so far. Debit, credit, credit. Paid payment for the asset. Cash. So we paid 100. Capitalization of employee salary 25% times 100 minus 25. Let's see an account. I remember I used some. Okay, I will take an account from here. Payroll expense production. Okay, capitalize. Depreciation. Equipment directly used in construction. Yeah, I will not use a debit here. I will use debit in the bottom. So let's see what we have for depreciation here. Depreciation expense equipment. And that would be 50% times 100. Let's think what else can we do here. Okay, that should be negative. As you can see, we credit our expenses. We reduce our expenses. Let me go to, because I'm going to add calculate Okay. Is everything clear so far? Are you able to follow me on that one? And we will capitalize it to equipment account. Okay. So let's go back to the guidance. So we figure out the stage on which we are on, and because the stage allow us to capitalize direct expenses, we recapitalized those. Let's go check what else do we have here. What interesting do we have here? We cannot capitalize that. Let's say rent and depreciation of admin building where engineers work on not capitalizable not capitalizable. Okay, so we did that part. Let's see. 46 minutes. Let's see what additional interesting details we can find for the guidance. Again, we repeat that directly identifiable should be capitalized, overhead costs are not directly related and should be expensed. That they probably mention it on every page of the guidance. Demolition costs. That's an interesting one. Demolition costs incurred by an owner or lessor should be charged to expense as incurred, except when incurred in conjunction with an acquisition or lease of a real estate and the demolition is contemplated. For example, if a reporting entity purchases land that includes a building upon acquisition, the reporting entity plans to demolish the structure or construct a new building, and demolition occurs within a reasonable period of time subsequent to acquisition. The costs incurred to demolish the property are part of preparing the site that should be capitalized as part of the land. So I am a bit concerned here about I'm a bit concerned here about a real estate, except when incurred in conjunction with the acquisition or lease of real estate. So what? That's an interesting question, and I will record it for myself to try to answer later. What if we are constructing a plant and we have to demolish some old plant to do that? What do we do in that case? Or when does it fall under real estate or will it be property, plant and equipment? The common logic would say that if we do that, if we cannot avoid that cost when we work on a plant, we should probably capitalize that cost. Contributions. From time to time, when you do some major construction, a local government can oblige you to do some construction which they need, like electricity line, piping, or something like that. Contributions should be expensed in the period made. So if you have something which local government obliged you to do, you most likely expense it. But now you know that if local government obliged you to do something, there is a guidance about that. Asset ready for intended use operating levels. Costs incurred during the transaction stage before the plant can operate are capitalized. For example, the cost to run machinery and equipment in order to test the output meets the certain regulatory specifications should be considered costs of the construction stage and should be capitalized. The construction stage ends when long-lived assets are ready for their intended use. So let's copy a bit of it here. And let's incorporate that in our working files. Okay, where is my practice? Okay, 5. Cost to run machinery and equipment in order to test that the output meets certain regulatory specifications. 100. First of all, I would say we need we will have to recognize. You see, I'm crediting payroll here. I'm crediting depreciation here. So I'm assuming that these expenses were expensed first, and we might want to expense them first. So usually you run your entries as you usually do. If it's a payroll expense, you debit it to payroll expense. If it's depreciation, you debit it to depreciation. And then at the end of the period, you credit the amount, the capitalization amounts. And that's why, let's see, what do I have anything? Okay, I actually do not have such an expense here. Let's call it testing. Let's say we booked that amount to testing expenses. Okay, so let's move. So when we do some test runs and our equipment is not ready, so we do test runs to figure out if our equipment is ready for actual production, that our output meets certain criteria, regulatory requirements. Then we capitalize these amounts as well. Okay, sorry, 10 seconds break. Okay, 12:30, probably 15 or 30 minutes more. Where is my PDF? An example, operating costs incurred during the construction stage. And that will be a tricky example. An amusement park has a soft opening to the public to conduct a trial run of its attractions. Tickets are sold at 50% discount and the park is running at 40% operating capacity. The amusement park will officially open in 3 months. Management asserts that the soft opening is necessary for the amusement park to ensure it is capable of operating in its intended manner. Should the operating costs during the soft opening be capitalized? And the answer is no. The soft operating costs should not be capitalized, but instead should be expensed as incurred. Even though the amusement park is running at less than full operating capacity, it is clear that the amusement park is capable of operating in the intended manner. So the difference between, so in that case, it's not capitalized, it should be expensed. But in a situation when you just kind of build the attractions in the park, and you hire some consultants or you do it yourself, and you, for example, test the capacity, like you just put, I don't know, bags of sand instead of passengers, and you run the attractions to see that they are not breaking and they are not stopping and they operate as intended. In that case, you will be able to capitalize those costs. But or if regulation requires you to perform some tests, so if your law requires you to do something to open a park and you do that, then it might be capitalized. But in case when you open as usual to the people, but as somewhat lower capacity and lower prices, that means that you are actually selling a service to a customer. So whatever, if you can recognize the revenue in that transaction, that means that you already opened and you need to move to the next stage. Okay, and a similar example, manufacturing companies in constructing a facility in China. The facility has been completed and is producing prototype parts, which are being tested to ensure they are in accordance with the customer quality specifications. So as you might note, it's prototype parts, and they are tested to ensure that they are in accordance with the customer specifications. So most likely you will not sell those prototype parts to the customer. And that means that in such case you can capitalize this stuff. And the last stage is in-service stage, which begins when the asset is substantially complete and ready for its intended use. So intended use for an asset is a revenue generation, and to be able to generate the revenue, let me move myself somewhere here just to not take a lot of the screen. Okay, so intended use of the assets is usually to generate revenue, services, products, and when you put it in the operation, when you substantially complete it, you have the following expenses when it's in service. You have repair and maintenance of existing components, replacement of existing components, or purchase of additional components. Costs incurred to acquire additional components of PP&E or replace existing components of PP&E should be capitalized. The costs, so acquire additional, and the main word here is additional, or replace existing components should be capitalized. The cost of normal, recurring, or periodic repairs and maintenance activities and all other costs related to PP&E incurred during this stage should be expensed as incurred. And in other words, during the in-service stage that extends the existing service potential of the long-lived assets or replace significant components of the long-lived assets should be capitalized. So as you remember, we have these criteria. So first, what costs can be capitalized after we put the assets into operation? So we either improve capacity of the assets, like we can produce more with the same assets after improvement, or maybe we improve efficiency of the assets so we can produce the same amount of output but with lower cost, with lower electricity consumption. That's also capitalizable. Or we can, for example, extend the useful life of the asset. So these are two: improve the assets or extend its useful life. When you meet any of these criteria, you can capitalize the costs. So you will not expense the cost, you will capitalize the costs. And most of the time, purchase of additional components will improve your assets. So since they are called additional components, they can improve your asset. And replacement of existing components, that usually extends useful life of your assets. And for that, you can kind of capitalize that as well. Cost to remodel a supermarket. Here is an example. So supermarket is remodeled to increase in size, have more available space, promotion outlets, and all of that stuff. And yes, these are capitalizable because there is additional value. There is increase in the improvement in your assets. That's why it can be capitalized. Okay, so here we have some example which I put in question earlier. PP&E Corporation has an existing factory that it intends to demolish and redevelop. During the redevelopment period, the company will move its production facilities to another temporary site. The following costs will be incurred for the project: rent of $500K for the temporary site, removal cost of $300K to transport the machinery from the old location to the temporary location, $1 million to install the machinery in the temporary location. Can these costs be capitalized as part of the cost of the new building? No. Even though the costs are incremental, they are not directly attributable to the new building and not necessarily for it to be capable of operating in the manner intended by management. The costs related to the temporary facility should be expensed as incurred. Though it doesn't touch the demolish aspect of it. You see, we moved our old stuff to the new place, and we started the construction of the new stuff on our old site. And whatever we spent on that move, it's not capitalizable because we already have those assets in place. And we kind of have that production facility in place, an old production facility, we have it in place. And if we move it to the new place, it is still that old production facility. So whatever we spent on the move, it's associated with that production facility. And it is not capitalized because if it doesn't change the quality of our assets, or if it doesn't change the useful life of our production facility, then we do not capitalize it. If along with these moves we did some improvements to our old production facility, then we can capitalize some costs that directly relate to those improvements. Or, for example, let's say we need to move our production facility to extend it because in our old place we probably do not have enough land to do that, or we do not have enough permits, or for any other reason. So in that case, we might consider to capitalize the moving expenses because the new assets will be a better asset and it may also extend the useful life. So depending on the circumstances, some of these expenses may be eligible for capitalization, and in some circumstances they might not be eligible. Again, as we touches it briefly, US GAAP doesn't permit the threshold for capitalization. So you might ask a question: do I capitalize small stuff? I don't know, like buckets, tables. What if I buy a table? Do I have to capitalize it? So the standard says that you have to capitalize it. but if it's a table in the billion-dollar corporation, you can probably have a policy to skip and do not overload your PP&E accounting with minor items. Theoretically, a lot of low-cost items can have a useful life of more than 12 months and transfer price over some period of time. So the answer is that practically you can do that, though it is not permitted under the standard. In our company, we do that. We have, I believe, $3,000 threshold for capitalization. So whatever is less than $3,000, we just do not capitalize it. So use of capitalization threshold is not an accounting policy election. And here we have a table which provides us with different type of costs and which says whether we can capitalize or expense it. And as you can see on the preliminary stage, everything is expense. Demolition, only demolition, it depends. So if you have to deal with demolition, you need to apply double, how to say it? You need to double your attention. You need to read the guidance with increased attention because demolition is kind of a tricky one. Land option, so you capitalize it even on a preliminary stage. Materials and supplies, it depends, it's interesting. Okay, if they have an alternative use, you can capitalize those. Project financing, external fees, specific incremental costs directly attributable to a project financing should be capitalized. Yeah, there is still some items which can be expensed. Let's read what we have here about demolition. Demolition costs should be expensed as incurred except in certain situations when incurred in conjunction with an acquisition or lease of real estate. So I'm not sure, like, if we acquired a piece of land and demolish a building and build it our plant there, we probably can, in certain circumstances, capitalize demolition costs. But more research needs to be done about that. I know that practically, when we do some demolitions, that's usually like when we hire some company to build us a plant, and they say, okay, we build you a plant for $2 million, and any demolition which they have to do on that land, it will be included in their charge, and their charge will be capitalized. So practically and most frequently your demolition costs will not be material, but in some industries and some cases it can be material part of your assets. So you'll need to double check with the guidance available on that matter. Legal fees can be capitalized. Materials and supplies capitalized on pre-acquisition and construction phase. Operating contract negotiation, fuel supply. I honestly don't even know what contract negotiation costs. It is like we go to a restaurant and negotiate a contract in the restaurants, or we hire an intermediary, a mediator to negotiate. But whatever, they say expense, so it's probably just an overhead. So overheads, indirect costs, they are expensed. Overhead, generally expense. Outsourced admin functions, expense. Property taxes, expense, it's an overhead. Project financing, internal costs and salaries, expense. Salaries can be capitalized. Site security, capitalize. So on these pages, you have quite an exhaustive list. Okay, let's finish two items which I wanted to look at. The first one is capitalized interest. And if we have a construction, if we have a qualifying assets, usually most of the companies have some debts on their balance sheet, in their liabilities, and they pay interest on those debts. And they have assets. And when they make a construction decision, a decision to start construction of the assets, they will have to finance that asset somehow. So first option, they decide to add an asset, and they will have to take an additional loan to finance that assets. And the second option, if they decide to build that asset, they may want to finance it with own funds. In that case, those funds, again, theoretically, those funds are not used to repay the old loan. They are used to pay for the assets. And in both situations, in both of them, you need to decide whether you need to capitalize your borrowing costs to the cost of your asset. Let's see what's the reasoning for that capitalization. The historical cost of acquiring an asset should include all costs necessary to bring it to the condition and location necessary for its intended use. As a result, the cost incurred in financing expenditures for an asset during the required construction or development period is itself a part of the asset's historical acquisition costs. The cost and effect relationship between acquiring assets and the incurrence of interest costs makes interest costs analogous to direct costs that is readily and objectively assignable to the acquired assets. So that's where they conclude that we are kind of have to capitalize that. Just give me a second. Got some cold here. And first of all, we need to identify qualifying assets. Assets that are constructed or otherwise produced by an entity own use, including assets constructed or produced for the entity by others for which deposits or progress payments have been made. So basically, your first criteria is that you have construction in progress on your balance sheet or prepayment for the fixed assets. You have to spend the cash. You have to pay cash for that assets first and have it on your balance sheet as an asset. If you keep cash, it's probably not a finance cost. Assets intended for sale or lease that are constructed or otherwise produced as discrete projects. For example, ships or real estate developments. That's when you do construction for like resale. Investments accounted for by the equity method, while the investee has activities in progress necessary to commence its planned principal. So this is related to investment. So we will mostly consider that situation. These two open us to a great deal of more accounting guidance. So let's look at the construction of assets. Interest shall not be capitalized for the following types of assets. Assets that are in use or ready for their intended use. So if you finish the construction and your assets is ready in use or in service, you stop capitalizing. Assets that are not being used in the earning activities of the entity and that are not undergoing the activities necessary to get them ready to use. So if you abandon construction of an assets, you stop capitalizing the interest. assets that are not included in the consolidated balance sheet of the parent entity. So if it's not your asset, you do not capitalize it. Invested account, okay, it's investments, non-profits, donors, inventories, and you do not capitalize on inventories which are produced in large quantities or on repetitive basis. The exercise of the following characteristic may help in identifying discrete projects. Separate cost records, considerable time period involved in construction and manufacture, significant expenditures, complying with customer specifications, progress payment. So you need to identify separate significant projects to capitalize. Interest costs that theoretically could have been avoided if expenditures for qualifying assets had not been made should be capitalized. So again, when you construct an asset, you have assets equal to liabilities. If you get a new asset and you capitalize and you get a new borrowing for that assets, you incur incremental interest expense due to construction of that assets. Or if your total assets and liabilities stay the same, but you take your cash and you can invest it in your new asset, you could have used that cash to repay the old borrowings and to reduce your interest expense. That's interest cost that theoretically could have been avoided. ASC permits some flexibility in determining the capitalization rate, and capitalization rate is either directly attributable. When you take a new loan for new assets, your capitalization rate will be an interest rate on that loan, or if you have a mix of loans, you might use the weighted average interest rate for that purpose. Okay, calculation. We have calculation example here, and I'm running out of time. So in that example, you see, we invested directly attributable expenditures. We invested the following in the asset: 100K here, 400K October, 400K November, 400K December. Okay. And what they are doing here, they calculated the rate. Let's see. Capitalization period. Okay, their interest rate is 4%. So what they're trying to do here, this 4% is an annual rate. So if you acquired something in September, you only have this balance to 3.4 months. They use mid of the month. So they assume you spent 100K in the middle of September. So you have only 3.5 months left in the year. And in October, it's only 2.5 months. In November, it's 1.5. And in December, it's only 0.5 months. So assuming you spend that in the middle of the month. And here, they try to calculate kind of annualized weighted average qualifying expenditures. They try to calculate your annualized weighted balance. So for example, you spend 400K in the middle of December for an asset. Your what amount should you capitalize? Let's see. We have 4% interest rate here and 400K here. I will give you an example. Так. Okay. Spend 400K in mid-des for an asset. 4% interest rate. So first situation, let's see. We just take only part of their example. So first case, we say that amount, how do they call it? Let's see, weighted average qualifying expenditures. Okay, doesn't want to copy. So it should be 400,000 divided by 12 divided by 2. And then we can multiply it by 4%. So that would be $666 to capitalize. Let's call it first approach. Let's call it qualifying expenditures. Резиночка. Спасибо, сынок. Ты опять ко мне пришел?
Да.
Давай, на ручки.
Да.
А что с резиночкой будем делать?
Я просто думаю, что она тебе будет нужна.
Ты соскучился?
Да. По кому?
По кому? По мне.
Да, откуда
И я по тебе соскучился.
Мама мне принесет штучку, которую я надеюсь, что она мне понравится. И мама надеется, что она мне понравится. Я очень.
So, and second approach.
Мама, ты нашла ее?
Effective interest rate.
Я с папой в кабинете.
Okay. And that will be the same. So main logic we have here is that we can only apply interest rate to half a month. So we can take 4% and divide by 12 and we will get monthly interest rate. And divide by 2 again and we get that small interest rate. And then we can multiply that interest rate by 400,000. And we get same result. We will practice a bit more of that on practice, but the idea is that you calculate for how long do you keep that expenditure as construction in progress, and then you allocate your weighted average interest rate to that. And there is quite a bit more of the guidance on that topic, but I plan to finish soon. So we capitalize interest when we made the expenditures. We sent cash somewhere, we spent cash. Activities that are necessary to get asset ready for intended use are in progress, so we are working on the asset. And we incur interest costs. In that case, we can capitalize. Okay, materiality. So if it's small interest, immaterial amounts can be neglected. Pretty small. Materiality is a complex concept, on the other hand. So if it's just like a very small percentage of your earnings that you capitalize, you can probably not capitalize it if the calculation is complex. Okay, maintenance and major maintenance. That topic mostly concerns the airline guide, because it first emerged in the airlines, but some guidance from here can be used in different areas. So I will skip it for now. The only topic which I wanted to consider was asset retirement obligations. And again, that concerns your like environmental obligations. Is a legal obligation associated with the retirement of a tangible long-lived asset that results from acquisition, construction, development, and or normal operation of that assets. Capital-intensive companies may have significant errors due to their ownership of major productive assets and ultimately will be removed from service. So let's imagine a nuclear plant, and that nuclear plant obtained some permit from local authorities, and that nuclear plant has some operating life cycle. It cannot live forever. At some point you will have to decommission it. And when you decommission it, you will incur huge expenses. It is an expense which will happen in a long future. But when you started to build that plant, you incurred the liability to reclaim the land when you retire your plant. And there is a separate standards on calculation. I can say briefly that you recognize that liability when you obtain a liability, when you incur, like when you enter in that type of contract. So when you get the liability, the obligation to reclaim the land, at that point you will recognize that liability. And you get that liability, that obligation, when you enter into the construction process. So what is an accounting for that? And that's something which many people miss. In established companies, it's already established, but in a new company that may miss. So for example, let's say we acquire an asset for 1,000. Upon retirement, we will have to reclaim land for 5,000. For 5,000 upon retirement in, let's say, 50 years, the discounted aero liability is 500. So what do we do? Debit, credit, credit. We spend cash on that asset, 1,000, and we recognize an aero liability of 500. And those are all credits. And we can debit it differently, or we can debit the same account. I will have to delete this later. Let's debit two separate accounts. Asset for 1,000 and aero asset. Let me copy. Asset retirement obligation. Oh. So when we got into that obligation with local government or whoever or landowner, and we buy an asset and we got into that obligation is our current expense because we already are obliged to reclaim the land, and because we incurred it into relation to the construction of the asset, we capitalize it, and then over time we will depreciate it along with that asset, and that current RO liability discounted, we will incur interest expense. So in 50 years, this 500 should become 5,000, unless we do not have any re-estimations. And RO, asset retirement obligation, is also a separate area of accounting specific to some manufacturing and production assets. So with that, I'm ending today's lecture. Thanks everyone for coming. Hopefully you got quite a bit of new information and food for thought, and you got accounting guidance for PP&E. I will do a short practice session today in the evening. Everyone is welcome. Let me know. You can send all the questions you have to chats, to Messenger chat and to Telegram chat. That was a long day today. Thanks for everyone who has enough willpower and motivation to stay, and have a rest of your Saturday. Have a great rest of your Saturday till the practice session today. Thank you. Bye bye.